March quarter earnings of ACC, one of the largest cement manufacturers, has once again highlighted the company's strength in a critical market environment. In our Ideas for Profit today, I will discuss whether ACC can prove to be a long-term survivor in challenging times. ACC reported revenues of over 3,400 crore rupees in Q1 CY20. Revenues declined 11% year-on-year on the back of contraction in cement volumes. The volumes were largely stable throughout January and February. However, the lockdown in March has adversely impacted the cement offtake and also dragged the volumes lower. Now, gross margins expanded on the back of richer product mix and also lower raw material prices. Also, EBITDA for the quarter gone by stood at 586 crore rupees as compared to 532 crore rupees over the same period last year. Now, realizations were muted across ACC's key operating markets like South and East. Also, the realizations were supported by increased focus on the premium segment and also value-added solutions. During the quarter, the company also commissioned 2 new plants of RMC, that's ready mix concrete, to strengthen the footprint in the building materials industry. The cement sector overall is in a precarious position as the timing of COVID-19 outbreak coincides with the peak demand season, that is January to June. In terms of project execution, and the lockdown is expected to have a severe impact on revenues and margins during the most profitable quarters. Now, ACC's plants and offices are shut temporarily and the company is planning to resume operations in a phased manner. Also, extension of lockdown beyond May could aggravate the existing liquidity squeeze and have a cascading effect on all sectors, especially cement. For FY21, CRISIL has expected that cement demand can contract by 10 to 15%. Besides, the companies will face working capital challenges due to non-payment from dealers for unsold inventories as well. Now, the economy continues to be under lockdown, but partial resumption of construction activities, that's road, infrastructure, etc., should gradually ease out the company and dealer inventory levels. However, the ramp-up in production and execution appears unlikely until the monsoon season due to migration of labor back homewards and also restrictions on the operations. For ACC, both the volumes and realizations should see downward pressure across geographies. The company seems quite well positioned right now to overcome the current challenges owing to the strong balance sheet it has. At the end of December 2019, it had cash balance in the excess of about 4,000 crore rupees, which should really help it survive the crisis. Now, in terms of valuations, the stock currently trades at about 7 times trailing 12 months EV to EBITDA, which is significant discount to similar sized peers. While we maintain our positive stance on the business and its long-term visibility, going forward, the stock market continues to be volatile and that could hamper the stock movement, and investors should therefore wait for market correction to really accumulate the stock with a long-term view.